Good afternoon, everyone. In today's video, I'd like to take the opportunity to review our two different kinds of futures volatility box setups that we have. Once we go through each of the setups, we'll also then take a look at the Nasdaq and the S&P 500 futures for today, which should hopefully help you see the markets a little bit differently and identify these setups as they actually occur real time. Starting off first, our first setup here is our trend pullbacks. That's where we're looking to play moves into our volatility box. That's the key differentiator here. Our two different setups are either playing moves into the volatility box or playing moves away from the volatility box. Let's start with the one where we play moves into, and that's our trend pullback. For that setup, our entry is really based on two different indicators. That's either the squeeze signals indicator, which is the cyan or the pink arrow right here, or our slingshot squeeze indicator, which is a yellow arrow, and you can see that right here as well. Now, the whole premise here is we're looking for overbought, oversold pullbacks, where we also have a squeeze forming. That's a TTM squeeze, but our triple pro version. And as long as we have both of those, then we have this idea that there's a bit of tailwind supporting the fact that we expect price action to rally inside to our volatility box zones. Now, there's really two key criteria or rules that I also look at outside of just the two signals. The first is, say we have bearish signals, I'd like to see an overall bearish market pulse. That means red or gray, but absolutely no green on our chart. So that's rule number one. And then rule number two is if we are looking to play these trending moves, then we should see that we're not inside of any extended volatility box zone. That's to say, if we had these bearish signals actually plot somewhere right down here, that setup would be invalid since that's a place we're normally looking to get long. There's absolutely no point why we should be interested in getting short. We expect price to really exhaust here and reverse, so the short setups there are not valid. So hopefully that helps to give you an idea of what the setup is. So again, just to recap, our two entry signals here, the actual triggers, the squeeze signal or the slingshot squeeze. You could also use the edge signals indicator, but that's a bit more aggressive in my opinion. Then we have our target, where our target is the other side's volatility box grade target line. This is that first level in our volatility box zone, and that's where we're looking to take off our first batch of contracts. So in this case, for example here, we have two bearish squeeze signal arrows plotted. We have an overall bearish market pulse line, and the trade is valid. We're looking for an entry as close to the market pulse as possible with our target at the gray target line. Now, it doesn't usually work out as nicely as this does. There's usually a bit more of chopping around sideways before price action starts to get down, but that gives you an idea of what the setup entails. Now, one question we get quite often is what happens, say, if the next hour comes about, but we have yet to hit the stop or the target. That's where that same hour's target line is what's carried over, and the target remains the same. So really, once you have the trade set up, you can really set it and forget it in the case of the trending pullbacks. Our stop in this case is outside of the other side's volatility box clouds. So with our bearish signals right here, our stop would be outside of the upper edge of the volatility box. Keep in mind that does usually require larger risk than I think most accounts can handle. And so some ways you could mitigate that risk is by using micro futures or things like the actual ETF, so the SPY or the XPX, or the options on the underlying ETF. So SPY options, out of the money ones, using the gray target line is a great rule of thumb that I found that works more often than not. All right, so with that in mind, that was the first setup. Now let's carry on to the second setup before we dive into the actual charts here. So our second setup is the fade setup. This is the one talked about most frequently in our videos. It's our bread and butter setup. And that's where we're looking to play moves away from the volatility box. That's where if price action falls into our volatility box zone, that's our cyan entry line. Once we see that breach, we're looking for an edge signal confirmation. That's this green arrow right here in the case of a long, or a red arrow in the case of a short. And once we get that, the trade is a go. We're looking for an entry at the cyan line, and if we get that retest, like you do right here, then that's pretty much it. The trade self-manages itself one more time. Our target is the minimum amount that we risk, and that's our first target. So in this case right here, that would be T1, and our second target is at the opposite side's gray target line. We're looking for nicer reversals with our fade setups, and it's when we hit that T2, which really makes this trade a phenomenal trade where oftentimes you're risking something like 0 to try and make, say, 20, 30 S&P points, which for all of our futures traders, you know exactly how that works and how well that works whenever we get those home run sort of trades. Now, our stop here, again, is outside of the volatility box cloud on the first contract, and once we hit the first target, we move that stop up to break even to try and see how high is high. So that really gives you a risk-free opportunity to play moves into T2. All right, so hopefully this was a good recap of the two setups. Again, let me just go over this one more time. We have our trend pullbacks that's looking to play moves into the volatility box. Using our squeeze course indicators there, we just confirm the trend and make sure we're not extended. As long as those two conditions are met, the trade is a go. And then our second setup is our volatility box fade, where we're looking to try and play moves away from the volatility box as long as we get an edge signal confirmation once we see a breach of these sign entry lines. All right, let's now move on to charts to take a look at these examples in real life based off of today's activity. All right, so starting off here with the Nasdaq futures, I'll try and go through this a bit quicker. We have a 1 minute chart, the scalper volatility box plotted on, and we're looking for either this trending setup or our fade setup. Now, the first time we had either of those two setups trigger was when price action in the Nasdaq breached our sign entry line. This is where once we breach, we're looking for bearish edge signal arrows. We get that right here. We're ignoring all of these squeeze signals, right? Because we're already in our upper bound of the volatility box. This is where we're typically expecting price action to start to reverse. So we ignore all of these. In fact, the short is the only one that actually triggered real time. We also had an opportunity to enter at the sign line or better, and we had to deal with a bit of heat in this trade as price action went inside of our clouds before ultimately reversing and then hitting our first target. First target in this was a bare minimum move of 20.5-ish points, and our second target was at the gray target line at 45 points. Both T1 and T2 were hit on the Nasdaq futures, which made for a fairly nice trade. So this is an example of the fade setup. Now let me keep going forward here. We also had false signals right here. And I'm going to use all of these as illustrative points. So we had bullish squeeze signals plot, but we had an overall bearish market pulse, right? You'll see we were green to gray to then red. So no clarity here. These signals also do not meet our rules. So let me keep zooming out here. Now we had another fade setup when price action fell into our volatility box clouds into that 9 to 10 a.m. Pacific hour. So we had price action fall into our sign entry line. We then had an edge signal confirmation along with an opportunity to enter at the sign line or better. Again, to give you an idea of what that T1 is for that 9 to 10 a.m. Pacific hour today, that T1 was right around 18 points. T2 was a bit smaller here, 25 points, but both T1 and T2 were hit. We're now looking for new setups again. And our next batch of signals come right here. That's where we have our squeeze signal along with our slingshot squeeze, but we're very close to that upper bound of the volatility box zone, which to give you an idea of what this risk to reward looks like, that didn't make a whole lot of sense. You were trying to make something like 10 points, but to try and make that 10 points, you had to risk 43, 44 points. Didn't make a lot of sense. You did hit that 10 points for those that did take that trade, but this right here to me isn't a very compelling trade setup. So again, this was one that I keep ignoring. I'd like to make sure that we have a good risk to reward here, and more times than not, I'll show you what that looks like on the S&P as well, just to cycle through. But we usually see those signals in the middle of the box where your risk reward is at least a 1-to-1. Now let me actually switch gears on that note and come into our S&P 500 futures chart right here. So if we load in the S&P 500, this is a better example of that trending setup that we're looking at, where we had bearish squeeze signals plot. We had an overall bearish market pulse line. We're looking for a move into our gray target line. That risk or the reward there was 5.33 points. And our risk on this trade, to give you an idea of what was expected, was right around 8 or so points, which makes that a bit better in terms of risk to reward. Very similar right here as well. You'll notice price action gives you room for price to really go and hit our target line, where you can try and skew the risk to reward in your favor. Another little trick here that a lot of folks may find useful, especially for those that trade options, is using out of the money options and using the strike where we have our gray target line plotted as that out of the money strike to try and play moves into, where when price action hits that level, that option goes from out of the money to at the money, and sometimes even in the money if you go inside of the clouds. All right, so hopefully this gives you an idea of the two different volatility box setups that we have, how to use them, along with clarity of how to recognize these setups as they actually form real time. Hope this video helps. If you have any questions, feel free to email us. Otherwise, take care everyone and happy trading.